Hi friends, how are you doing out there? I hope the market's treating you well, and what a week it was last week. We were waiting for a potential breakout from a flag formation, and the Nifty almost did just that. But that is not the high point of the week. What I noticed in my data, and I'm going to present this in the video by way of graphics, and I remind you that many of these studies you will never ever find in the public domain because these are in-house studies of our statistical model, which we fondly call the Barracuda. So the high point of the week was that after a while, the prop traders, the prop positions of the brokers, the professional guys, the savvy guys, and the FIIs started showing signs of going long, at least on the indices. And so far, it was the retail traders who were leading the barrage of buy orders. But now that the FIIs and the prop traders have started lending their weight on the buy side, it could get to be a very interesting week going forward. So let's take a look at the market roundup out here on your screen. You can very clearly see that the bank Nifty outperformed the Nifty due to a variety of reasons. One was the public sector banks could get a disinvestment nod. The bad loan recovery under the Indian bankruptcy code, which the RBI has given a kind of a go-ahead, and the very fact that the RBI has given a large check, a little over 99,000 crores to the government for the 9-month period ending, which the RBI had as a surplus. It was expected to sort of ease the liquidity crunch for the government. So all these factors led to the bank Nifty outperforming the Nifty 50. Of course, there was a lot of bear covering also involved at lower levels. Now, the fact that the US dollar index and the USD INR, the US dollar index is a basket of US currency, is a basket of US dollar versus global currencies, and the USD INR is the rupee versus the dollar versus the rupee specifically. And both these showed signs of falling. And a falling dollar is invariably good for emerging markets because they are import-dependent nations, and a weak dollar basically curbs inflation. The fact that oil and gas prices fell also helped to boost emerging markets because oil, like I've told you very often, is a multiplier commodity. So the prices of oil impact everything from wheat, pulses, grains, milk, dairy products, fruits, vegetables, spices, transportation costs of almost everything. So the fact that oil prices were down along with the dollar also cushioned a lot of markets here. Gold rose very mildly due to defensive buying because cryptocurrencies saw a huge amount of volatility last week, which was again the high point of the last week. Silver, on the other hand, eased very slightly on profit-taking considerations. The other thing that you can see is that the 10-year benchmark bond yield fell slightly, just as the RBI wanted it to. Now coming up on your screen is the MWPL, the market-wide position limit chart, which suggests that it rose mildly due to retail buying interest. I think the peak has been reached, and since we are looking at 4 days ahead of expiry, I think the MWPL will either taper off or even fall marginally in the coming sessions. Now on your screen is the basis chart. The basis is nothing but the premium that a future enjoys over the spot. Now, the basis chart on your screen shows a rise in both the Nifty and the Bank Nifty on a week-on-week basis due to short covering on rallies. The bears are clearly on the defensive, and therefore they are paying higher prices to cover their shorts. This is called a short squeeze. It's pushing the basis higher. And also now on your screen, look at the volume chart of the indices and the collective stock futures. May I remind you that these are cumulative series of May, June and July. The rally on Friday in prices was accompanied by a spike in traded volumes, which is a positive indicator because the amount of participation that you saw in the markets was higher. Now take a look at the impetus chart on your screen. It shows both the indices moved up on Friday with rising momentum or velocity, which is another short-term positive for the bulls. Now here again, I remind you that the impetus is something that we added a couple of weeks ago. This is again another study you won't find anywhere else in the public domain. Now here comes the studies that we've added only last week. Take a look at the chart on your screen, which shows FII open interest in futures. Their stock futures open interest continues to fall, but the index futures open interest hit a 3-week high. Now, where the chart of the professional and prop positions are concerned, open interest are concerned, they seem to have reduced stock futures open interest. Part of it may be due to the impending expiry, and they cut their net shorts in the index futures. Now, most of these brokerage prop trades were on net negative on the indices, but they seem to be covering their shorts, which means they are expecting the markets to possibly go higher. Now, this is not just talk. I'm basically giving you data of what people are actually doing. No talk, actually doing with real money. So this is where the action is captured. No myth, no rumor mongering, no herd on the street, no whispers. This is plain action. Now take a look at the retail traders action chart in terms of open interest. They seem to have mopped up all the selling in stock futures by the FIIs and prop traders, but they reduced their index open interest to a 3-week low. So after having bought stock futures, they reduced their index futures to a 3-week low. Now, why are they reducing index futures? Because they are possibly sitting on profits in the index, and therefore they are cutting their long positions and booking profits. And concentrating their bets on stock futures is actually showing that the retail risk appetite is increasing. Do remember that volatility in individual stock futures is significantly higher than index futures. So it's showing higher aggression by retail traders in the near term, and this is a broad-based phenomena in many markets where the rally is powered by retail traders, whereas prop books and FIIs may be selling. So it's a brave new world, it's a brave new stock market where Reddit, Robinhood and retail guys are actually humbling the hedge funds, the mutual funds, the pension funds and even the brokerage firms. Friends, the roundup is done. Let's now go to the 10-year benchmark bond yield. The chart on your screen shows you that the RBI managed to have its way of having lower 10-year bond yields, and it also announced a big payout of almost 1 trillion rupees, a little less than 1 lakh crores, to the government of India for the 9-month period. And as I record this video on Saturday morning, I have no information on the Government Securities Acquisition Program version 2, which the RBI conducted on Thursday, the 20th of May. And I promise to update you about that event as and when I get the data announcement on from a credible source. Do connect with me on my social media accounts. I'm going to be posting this data on a day-to-day basis. And post-market late evening, I put out a lot of interesting data that might help you trade. My contact coordinates will come at the end of the video. Friends, the 10-year benchmark bond yield done. Let's now go to the Dixie or the US dollar index. This is the US currency benchmark, and the daily chart on your screen shows that the immediate near-term downtrend remained in place. The price is staying below its 25-day exponential moving average, and the 91.5 level, which I advocated last week as a near-term hurdle, still remains that hurdle. The bulls must cross over this area before they can be taken seriously. The weakness in the dollar is a major contributing factor to last week's strength in our markets along with other emerging markets. And the daily chart on your screen makes the weakness amply clear. Now, a weak dollar, like I told you, makes oil and gas cheaper, which I remind you are multiplier commodities and therefore curb inflation. The weekly chart on your screen now shows the price has hit a 1 quarter low and it remains far below its 25-week exponential moving average, which means the upsides may run into selling pressure. Last week, I advocated a range between 91.40 on the upside and 89.25 on the downside, which held perfectly well. The coming week can see an estimated, I stress upon the word estimated here, can see an estimated range between 91.10 on the upside and 89.90 on the downside. Friends, let's now go to the Bank Nifty, which was the star performer of last week, led by the announcement of loan recoveries under IBC, the RBI's payout to the government, and rumors of public sector banks disinvestment. And traders were fairly lively on most of the counters here. Check out the daily chart of the Bank Nifty. In the spot, the price is breaking out above its 25-day exponential moving average as well as a triangle formation. The big upthrust on Friday was the single contributing factor for the large gains that we saw last week. Of course, falling bond yields also helped. Note on your screen now in the weekly chart, the price has bounced before it tested the 25-week exponential moving average, exactly as I advocated last week. Last week I said that the bulls would get a fighting chance if the 25-week exponential moving average is not violated downwards and the market bounces from here. The bulls can get breathing space, which is exactly what happened. As long as the price stays above this 25-week exponential moving average, the outlook remains optimistic. In the week before last, this index was at number 5 on the most volatile stock list, whereas it rose 3 notches to hit the second highest in terms of volatility last week. This means retail traders should stay alert because the price swings will be big and also sudden. Last week I advocated a range between 33,925 on the upside and 30,400 on the downside, which was overcome on the upside to my very pleasant surprise. And the coming week is expected to see an estimated, I stress upon the word estimated, range between 36,450 on the upside and 32,775 on the downside. I would urge you to continuously watch my daily updates on my social media accounts. The contact coordinates will come up on your screen at the end of this video. Friends, let's now go to the Nifty 50, the most liquid instrument on the NSE, also enjoying the lowest impact cost. This index rose on 3 out of 5 trading sessions last week and relatively underperformed the Bank Nifty. Note how the daily chart shows the index rising above its 25-day exponential moving average, and it's also attempting to overcome the top end of the channel. Should that be done, it can be a flag formation that I discussed last week, and this is something that the bulls have been waiting for. Now do note that the 15,600 odd levels is a very interesting figure to watch rather than the 15,400 and some odd level, which was the previous all-time high. Why am I adding 150 points approximately to that? Because in the last 3 months, there would be, in addition to the all-time high, A cost of carry from Feb to March, March to April, and April to May. And this will be the level of 15,600 will be the level where all bulls in the market will be undeniably enjoying profits no matter what price they have paid for going long on the Nifty. Now, coming up on your screen is the weekly chart where the price is comfortably above its 25-week exponential moving average, which means the outlook is positive in the near term. The potential flag formation I mentioned last week on the weekly chart is visible immediately. All the bulls need to do is defend the round number of 15,000 in case the markets decline all of the coming week. They should not let it fall below 15,000. The week before last saw this index at number 13 on the most volatile list, but last week it rose to number 7, which means retail traders must exercise due care in their trades. Last week I advocated a range between 15,200 on the upside and 14,150, which held perfectly well in spite of all the volatility, where the all-time high, the weekly high was 14,190. Remember I said 15,200, just 10 points lower than my target. Wow. Now the coming week is likely to see an estimated range between 15,700 on the upside and 14,650 on the downside. Now the Jensen's measure, which is the yardstick for risk and reward, seems to point towards a slight improvement in the odds for buyers in the coming week, though high volatility remains a concern as far as I'm concerned. Now friends, the indice is done. I come to the most popular aspect of this video, where I'm going to give you 5 stocks which are high beta, high impetus stocks, wherein you take small exposure, wait for big price moves, and 5 stocks which are low beta, low impetus stocks, where you take large exposure and wait for small price moves. Different traders, different tools, and different techniques. So high beta, high impetus stocks are led by Bajaj Auto number 1, UPL number 2, number 3 Bata, number 4 Ashok Leyland, and number 5 Bharti Airtel. Low beta, low impetus stocks led by Lupin, number 2 Coforge, number 3 SRF, number 4 Navin Fluorine, and number 5 APL Limited. Friends, do note that this hierarchy of low beta, low impetus stocks will change from day on day basis, and which is why you must connect with me on social media, wherein I update almost everything that I've told you here on a daily basis. So whenever the markets do take a turn, you're not taken by surprise. Friends, if you like this video, do subscribe to my YouTube channel. Click on the bell icon to receive instant alerts for fresh videos being put up out here. In the comment section, I'd love to hear from you as to what you think about this video and what you like about these in-house tools that I'm sharing, and I'll share a whole lot more, I assure you, in the coming months ahead. Coming up on your screen, my friends, are my contact coordinates. Do connect with me. I'd love to hear from you and get conversations going. Also, do note in the description below this video is a hyperlink to my playlist on Equity Masters YouTube channel, wherein I put across my thoughts every day, 4 times a week, via my videos on this channel. Do also visit and subscribe Equity Masters channel to get my updates there. I wish you have a very, very profitable week ahead, my friends. Do take very good care of your trades and investments, your health, your family and friends. Thank you for your patience. Thank you for watching my video. Take care till we meet again next week. Bye-bye.